Welcome to another episode of the Capital Gains Tax Solutions Podcast, also streaming on Expert CRE Secrets Podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is an amazing way for you to exit highly appreciated assets, defer capital gains taxes, eliminate the need for the 1031 exchange so you can create and preserve more wealth. Hope your clients, friends, and family do the same. My name is Brett Swartz, and each and every episode we're joined by some of the best real estate, financial, wealth, and business minds in the world, where they share their ideas and deal stories. So together we make complex tax deferral strategies simple and passive income plans achievable. I'm excited about our next guest. He's out of the great state of Florida, and he's been heavily involved in the manufactured housing community industry for over 20 years. And he has helped to create and oversee a portfolio of 180 plus communities representing over 20,000 units across 20 different states, and has worked to create several distinct brands within the mobile housing, manufactured housing, including MHC America, pronounce that for me.
Elevation. Yeah, no, it's a hard
Elevation Capital Group, JRB Communities, and so much more. Please welcome to show me Ryan Smith. Ryan, how are we doing?
I'm doing great, man. Thanks for the time. Good to see you again.
Absolutely. And for our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Yeah. So I guess current focus is mobile home parks and self-storage. That's kind of been the same story for a long time. But yeah, I mean, simple treetop, I guess, by way of story, grew up pretty blue collar, real estate background. My dad did real estate, but it was, kind of nights and weekends. So every weekend we'd be at a property scraping, trenching, digging, hauling, that kind of stuff. Starting at a young age, and then started I moved into more of the evaluative side of the business. I was kind of a gearhead nerd. And so I love to do kind of the underwriting for the deals, and learned to code at a young age, ended up building a software application for decision analysis, for financial decision analysis for real estate transactions. And I built that as a teenager. Ended up having about 100,000 users of that software globally. Kind of mom and pops used to underwrite their own deals. Made quite a bit of money from that little software program, and then parlayed that into a portfolio of real estate that my wife and I built together. And all these years later, here we are. That is the epitome of a treetop story. Happy to go into any depth if you'd like, but that's real high level.
No, I love that, Ryan. And by the way, you can learn more about Ryan by going to Evolution. Am I pronouncing it right? I just keep getting tongue-tied.
Elevation. No, you're good. Elevation.
I think it's because it's all in one. It's all in one line. ElevationCapitalGroup.com. My mind is moving too fast this morning. Well, Ryan, I love that you came from a background of the sticks and bricks, right? The hard work, the grinding on the ground, boots on the ground, scraping. You said, doing all the things that you're doing to understand the essence of what it means to be in real estate and be a developer, be an owner with your dad, right? It's kind of in the blood. Love that. And then you went to the financial side, and then maybe the more detailed on the numbers, and then you're helping people create the wealth with that. And that's how you probably what distinctively helps you to be such prolific in what you've done so far. So talk to us before we go there, though. I do want to take one other step back. I wonder, was there like a gift where your dad said, or your parents said, "Hey, Brian, I feel like you have this gift of this, right? I want you to take that and I want you to develop that." What was kind of the natural gift that you feel like you were given, and how does it help how you help and bless people today?
I not that I can recall. I mean, in that way, but I would say, from a young age, I always liked people. I like sharing. I like seeing people do well, and so I think that has, I'd say it's almost a selfish kind of outcome to saying this is how it's helped me. That's not really the intent behind it. I truly and genuinely like people. I like celebrating their success, and I'm amazed to see the people that we've been able to know and grow with up until this point in time, and I would say our community continues to grow of friends and family, and it's been a lot of fun.
Absolutely. Great. Cool. Well, keeping that in mind, let's dive into the approach, the niche property investment that you guys approach with, right? Elevation's approach. And we're going to be talking in particular what that niche is, and then what has been kind of your guys's, I guess, sustained, consistent success over all of these years in different markets.
Yeah. So I guess, I'll kind of go back to the very beginning. My wife and I, when we started our business, and we're somewhat unique in that my wife and I worked together. We started the company together some 20 years ago, actually probably a little more than 20 years ago, and we still work together. And every point in between, which is somewhat unique. We have 4 young kids and all of that at the same time. But when we first started, we had a little bit of capital, that she had saved, I had saved, and we had some experience, and so we started building a portfolio of single family houses, and we built, to memory, I think it was like 25. We bought 25 single family houses in our early 20s with the goal of holding them long term, having the residents pay them off over time, and kind of that deal. We got to a point of, I think it was 25 or so, and we realized it wasn't as scalable as we thought it would be. And at that point in time, we had really, and this isn't to degrade or diminish what our parents had done, but we really were beyond what our parents had done in terms of asset ownership at that point in our early 20s. And so we're sitting here like, okay, well, what's next? Where do we go from here? Do we stay on the same course? Do we go for 50 properties, 100 properties, 200, whatever it is? Or do we kind of modify and change? And so we ended up spending an extended weekend, and we built basically an underwriting model for every asset class that we could think of. Self-storage, billboards, raw land, for land banking, timber, retail, office, hotel, motel, mobile home parks, the gamut, apartments, the gamut. And our thought was we would put all the analysis on a table and basically let the underwritings duke it out for which is the most viable. And so we were looking for the most viable path forward along at that point in time, 4 key criteria. And the 4 key criteria for our early 20s mind was these 4 things. So we wanted cash flow to the extent possible. We wanted good cash flow. We wanted cycle resiliency as much as could be obtained, in that we wanted off the economic roller coaster. So we wanted, an asset class and a model with, really long-term prospects of income growth to the extent it could be achieved. We wanted tax efficiency. I know that's music to your ears, but we wanted, some tax efficiency, and then capital appreciation. We wanted, the ability to take a dollar invested and grow it into 2 and 3 and 4, over time. So those were the 4 things we were looking for at that time. And so, by our analysis, the 2 asset classes at that time that came out ahead that we thought based on those 4 criteria were self-storage and mobile home parks. And so we went out, we started buying what started as mobile home parks. We started buying mobile home parks. We bought 1, we bought 2. We didn't know anybody in the space, didn't go to a mastermind or a conference or, any kind of workshop. We just went out and kind of bought one to see how it would go. And it went great. And so, we really, here we are, 20 some odd years later, we really haven't stopped. So anyway, that's kind of the origin of where we started and why, and kind of where we are.
Yeah, I think it makes a whole lot of sense. And you guys let the numbers speak for themselves, A, and then B, then you focused on those 2 asset classes. I also remember talking to you a couple of years ago, and we were talking about your guys' long-term hold strategy, if I recall, right? Where you're generally, and your investors themselves, you found that sometimes, in the early days, correct me if I'm wrong, like you'd sell and they pay all this tax, right? Or you wouldn't necessarily have a 1031 lined up. So you got to the point where you're like, you know what? Our goal is to basically, and correct me if I'm wrong, try not to ever sell, right? And just only ever own, take on good debt when it makes sense. Don't over leverage the portfolio, and just buy more and more and more, and continue to get more and more cost seg. Can you talk about that strategy and how that's worked out?
Yeah, it's worked out great. I mean, we think at the end of the day, you want to own quality assets, and you want to own them for the long term, and as a general, it sounds overly simplistic, but it's probably not too far off. You want to sell the bad and keep the good. But oftentimes, you find people selling the good and unable to sell the bad. So in a weird way, they sell the good, or they sell the good and keep the bad. And so for us, we want to buy quality, manage it well, hold long term. And the goal is to return capital to members as quickly as you can in any given investment vehicle. The goal is to return capital, when you can, and once that's achieved, you ideally you have assets left over, and members have their capital back. And so now that they have their capital back, they then could potentially have lingering economic interest in the property. So they have their capital back. They now own a portion of the portfolio. So they have assets left over. They have their capital back, and they continue to benefit from distributions into the future with a zero investment basis. So in that point in time, if you have an investment where you have no capital left invested in the deal, and you're getting distributions from that investment in the future, it's an infinite return on present capital, which is zero. So any distribution is infinite. To your point, if you use cost segregation or any kind of accelerated depreciation, you've taken a lot of depreciable losses early in the investment cycle. Your capital account balance, your tax basis is probably low to zero. And so conceptually down the way, if you sell the assets, you sell the properties, you could conceivably pay a lot of tax in the form of recapture. So you pay a lot of tax to get your money out of an investment vehicle yielding infinite return on present capital. So it doesn't make sense to pay tax, to get rid of an infinite vehicle so that you can then go redeploy your capital after tax, take new risk on a new investment, new assets, and make a lower return and pay tax to do it.
We're speaking with Ryan Smith at elevationcapitalgroup.com. It's elevationcapitalgroup.com. Yeah, Ryan, I think that's the key, right? The key, I think of like Boardwalk, Park Place, the old game of Monopoly, right? Collecting the best assets. Yeah, selling the ones that are the average to the ones that aren't doing great. And then being disciplined enough to not overpay in a marketplace that doesn't make a lot of sense. I'm curious, with all of your experience, right? What was your buying appetite, let's say before interest rates basically doubled, right? And to now where they're at right now? Give us your sense of opportunities, and give us your sense of how you perhaps fixed the debt before or didn't cash out refi as much. Like, just what give us the Money Morning quarterback. What did you do well the last 36 months? What could you have done better?
Yeah, I mean, as much as you can, you want to be balanced. You want to show restraint at some points in time. So I guess to answer your question, we've been fairly acquisitive for the last 15 years, and even before that, we've been buying along the various market cycles when interest rates were going up and then down, and when the economy was good and then it was bad, and then things cycle. But ultimately, what we try to do is take a balanced approach. So as it pertains to debt, we are not big users of variable floating rate debt. We like long-term fixed rates. We again generally are 50% loan to cost at closing, so we're generally 50% or lower. So we don't use what we think is an inordinate amount of debt, and the debt we do obtain is generally fixed long term. And so we were buying in 2016, 17, 18, 19, 20, into 21. We've bought some in 22, but not a ton. 2023, we just thought things were, generally speaking, pretty frothy, and we're starting to see now quite a few deals on our desk that we're evaluating, and I think we'll probably move forward with.
Excellent. That makes a lot of sense, and I think that's a great approach. Curious on just your returns that you've been able to do for your clients, right? I think this is really important to share. How have your returns been, and what's the outlook going forward as far as targets? Have you shifted those at all, or given that maybe values are going down a little bit here?
No, I would say we try to stick to our guns, and I say that because the market is always, as I think the last couple of years have shown, the market can change, and it can change wildly. And there's kind of two ways you can operate, and this is overly simplistic, but you can operate in response to the market and try to constantly, from a marketing lens and business development lens, you can kind of try to constantly shift your narrative and your business strategy to throw yourself into the current of what the market is wanting, what it's doing, what it thinks will happen, and and there's nothing wrong with that. But if you take that approach, your business model will probably change pretty drastically over time. And you see this now with a lot of, players in the space that are embracing, entirely new asset classes and or even concepts. There are people who used to be raising money for real estate deals, and now they're trying to buy businesses or whatnot. And they're kind of going with the flow of the market. And we take a different approach, which is, the market varies, it changes, it ebbs and flows, it modulates. But for us, we like what we do. We have a picture of where we're going, and we kind of stay the course. And there's times when a lot of people see things the way we see it and want to come join on the journey. There's times when there may be fewer people who want to do those same things, but we just stay the course, keep moving forward. And we've seen the ebbs and flows for a long time. So anyway, I say that it's not right or wrong, but that's just kind of our tact.
Yeah, that makes sense. It makes sense. You guys have found your guys' niche, your guys' focus, and regardless of the market conditions, you're going to be buying. You're typically not selling, and you're typically refinancing long-term fixed rate debt, and you're making sense of infinite returns to get the capital back to the investor as fast as you can in a reasonable way, right? That's
Yep.
prudent, and then it's just infinite returns holding those assets that are good ones. It's actually pretty simple. I mean, real estate's not that complicated. There are a number of single steps that you take and teams that you build. Now, I'm curious, when you have sold, what were the driving forces for the sale?
Yeah, so I guess, for us, it depends on, I guess, the context. So some of our earlier funds that we put together when we kind of transitioned from individual property ownership that, Jamie and I purchased directly, ourselves. And when we transitioned into, raising initially money from friends and family to put together a small fund. Our first fund was 2010. It was a $2 million raise from friends and family. It was a Reg D 506B offering. And so, for that, just for context, I was, I think, 29 at the time. Jamie was 20, I think 6 or 7. No, she was 27 at the time. And, we were raising money for our first fund amidst the GFC, the great financial crisis, for this asset class of mobile home parks that was really, not well known and liked even as it is today. It's much more institutional today than it was then. And so, when we formed our first fund, one of the early questions was, okay, and what's the long-term strategy? And so anyway, to make a real long story short, our earlier funds, we made it clear that we would be, buying the properties, improving them, and selling them, because that was more a function of what, at that point in time, our friends and family wanted, and we thought was aligned with their wants. But after doing a couple of those funds, we said, okay, we've built at least enough of a track record and a history with them that we can really pivot to what we thought was a better long-term model, and that's the long-term ownership.
Yep, makes perfect sense. Now I'm curious about, like, when people come to you with capital, right? And in particular, capital gains tax, and maybe even wanting to try to 1031 exchange into a fund, right? Or they're selling cryptocurrency or a business that's not even 1031 eligible, and they're like, Ryan, I'd love to invest with you, but it's all tied up in this, $15 million crypto or business or stock. And if I sell, I have to pay the tax. So walk us through maybe the frustration with the 1031 exchange, maybe not being able to go into a fund unless you figured out a way to do that. And what, what other frustrations are you having with the 1031 exchange?
Yeah, so we work a lot with exchanges, quite a bit. But to your point, you can't 1031 into a fund because it's not like kind. So, I guess I don't deal too much with the crypto side of things. I had a use case many years ago on crypto, but not since. And maybe a couple businesses, just kind of background, business grumblings, like I'm selling a business and I wish I could find a home for it. So it's definitely out there. But on the real estate side, we definitely deal with a lot of exchanges. So that's a frequent conversation.
Yeah, and so what has been your solution for that? I mean, we have one, right? It's called the deferred sales trust, where you can exit any asset of any kind, and you can also save a failed 1031. And then once the funds are in the trust, they can go right into your fund, all tax deferred. I think we placed over 40 million with the group recently, and they do a lot of multifamily investing, and they have a fund model with a lending fund as well as the actual building fund, and they have
Mhm.
like another housing fund. So what does that look like when they want to show up, but there's no way to get there in a clean way by deferring the tax?
Yeah, so the way we've done it is historically they go into a single asset. So they 1031 into a single asset. Um, yeah, as an initial step. That's kind of where they start. It's so it's not a fund in the way that it's not multi-asset at that point in time. It's just a single asset. So we do a lot of single asset 1031 exchanges.
Got like a joint venture partnership LLC, and then they
A
just come
tick.
in.
It's usually a
Yeah.
tick structure initially, and then possibly in years ahead um, they may exchange into other structures for various reasons, but it usually
Right.
starts as a tick.
And are you typically able to like then eventually maybe roll that property into the fund at a later
You
date to have the
could,
fund? Yeah.
yeah, you could, yeah, you that's an option.
Okay. Cool. That's interesting. Yeah, I haven't looked at that angle before. That's cool. Um, what question haven't I asked you that I should be asking you right now as far as anything about 2024 and buying opportunities? And it sounds like you pretty much stick to your fundamentals of what you're looking for, and
Mhm.
then you buy it when it makes sense. You guys have so much experience and so many units under management, but any other trends or thoughts or new states that you're going into or states that you're leaving that otherwise were the hottest states before? Like, what's any feedback for that, Ryan?
Yeah, no, I think there's a lot of things I'm watching. Jury's out on on which way any of this is going to go, but it's fun to watch. There's obviously the question around interest rates. I think a lot of people are, especially in the real estate industry, are kind of, I think, hoping for lower rates by year end. I'm not presently convinced that that's going to be the case. I tend to think rates are going to be higher from here, but could be wrong. But just kind of curiously watching that play out. We are starting to see deal flow increase. That it seems that sellers are much more amenable, or becoming more amenable to potentially lower prices, higher cap rates, more seller financing, more creativity, more flexibility, which is great. It seems like lenders are also um, kind of loosening, and from what I'm hearing in conversations we're having, lenders are I think poised to kind of lend more in 2024 as compared with 2023. So kind of watching that, and then as it pertains to our business and mobile home parks, we just continue to look at kind of the regulatory framework. Mobile home parks are a great asset class. It's a great business. It's a great way to provide quality housing for good folks who need it. And I think there's always bad apples, bad actors who really come in and rake people over the coals unnecessarily, and then states respond with regulation. And so I think that's something to watch for. I think there's pretty onerous regulation proposed in Delaware and Washington State and a couple of other states that would cap rental increase, basically rent control. So I'm watching that. And I don't think it's a good idea for people to treat people poorly. I also don't think a lot of the regulation, as I've seen it, solves the problem. I think it actually, in many cases, creates more harm than good. But nevertheless, something I'm watching.
Yeah, very well said. And we're talking with Ryan Smith, elevationcapitalgroup.com, elevationcapitalgroup.com. I want to fast forward, Ryan. You built an amazing fund, and it's tremendously successful, and you're doing great, everything you're doing. And I can tell you're doing it at a high level. I research and I talk with, and we invest with groups. And in fact, we haven't done it yet, but I'm looking forward to introducing a lot of our clients to you, and maybe even personally investing with you guys moving forward. I do want to fast forward like 5, 10, 15 years from now, right? Let's fast forward where the fund's going. And the one thing that we're looking at, I feel like a lot of people are missing out, is the death tax or the estate tax, right? And it's this 40%, elephant that's in the room. It's a huge amount versus the tiger by the tail, which is capital gains tax. And the exemptions are set to cut basically to 12 million married as of 2026 and about 6 million single. And so I imagine, people that your investors, perhaps you guys, I imagine you guys as well. What's been your strategy for, that? Because the stepped up basis does not solve that, right? It gives a stepped up basis for capital gains tax. But if someone's worth over $100 million and they only have a $12 million exemption, that other 88 million, if they're married, is subject to a 40% death tax. And so
Yeah.
that's, that's the Kevin Costner, if you've seen Yellowstone, I tell Kevin, you can solve it by, we use a DST plus to solve that, and no charity, no gifting, no life insurance required. But I'm just curious, what have been your ways, or what are your, how are you preparing for that?
Yeah, no, it's a great question, and it's a real challenge, because if you don't address it and tackle it, it kind of makes, it puts your heirs behind the potential eight ball, in that they may have to be forced sellers of an asset or a group of assets in order to pay the tax. And you see that actually a lot in farmland. Ironically, you have a lot of folks, it's generational asset, but they're forced to sell because of the tax on death, and it's pretty bad. So anyway, for us, I mean, for Jamie and I, and it's something that is on our radar. We're taking as many steps kind of before that burn off you described as we possibly can. And I definitely think, if your viewers are not aware of it, they should be. And if they're not doing something about it and need to, they probably should. I know we are. I know you probably are as well, and would tell your clients to do the same.
Yeah, I'll just give you a couple ideas. And so,
Yeah.
most folks, and at least for listeners too, right? They have some methods, right? And there's definitely some methods. There's some gifting. There's the life insurance to offset it, right? Because life insurance is a state tax, and basically tax free, but it only offsets. There's charity, give it away, which is great, and so, but beyond that, a lot of those things take a lot of time, or you have to have a lot of kids, or you run out of time. It's not very efficient, right? And so we have a solution called the Deferred Sales Trust Plus, known as the DST 2.0. Upon sale, just take a sale during your lifetime, you need to sell it. It moves from a owner to a lender, okay? In a particular way that we do it, it eliminates the estate tax outside your taxable estate, and your children can be the beneficiaries of the trust.
Mm-hmm.
And there's no longer estate tax. It's gone forever. It defers the capital gains tax, although there will be some capital gains tax paid over your lifetime.
Yep.
But it's a very efficient way. No charity, no life insurance, no gifting required. It also doesn't give up any of your lifetime exemption, a gifting amount.
Hmm.
And so if you have like a big $50 million, deal, you could do it in one day. Not only that, but it's important to understand that it has to take a sale. And so every single time we have a sale of something, if we're going to sell something, there's this window of tax planning, right, that you can capture. And if you don't, then you miss out on that window, right? So if you go too late on a 1031 exchange, or you don't set it up, you don't set up the deferred sales trust before closing. But this estate tax one is, I think, the most massive one, because there's $84 trillion set to transfer in the next 20 years. Those are the largest wealth transfers in the history of the planet. And to us, it's the battle for the wealth of American freedom, where the government not going to be very efficient with the capital versus the people to use it to build, mobile home parks, manufactured housing, multifamily. And so that's the concept, is that math piece and analyzing that. And so if people want to learn more about this, you can go to capitalgainstaxsolutions.com, where we in fact, we just helped a client, they're worth about 25-30 million, sell a $5 million multifamily property in Colorado, eliminate that $5 million of estate tax. And not only that, they're still mid 50s. All of the growth of that is outside the taxable estate.
Yeah,
and so you start thinking about that, the exponential, kind of like the infinite returns. Mm-hmm. It's no longer just about deferring 25 to 50% of capital gains tax. It's eliminating all of that outside your taxable estate and all of the growth. Any thoughts on that, Ryan?
I think that makes a lot of sense to me.
Yeah, cool. With that being said, are you ready for the lightning round?
Ready.
All right. Knowing what you know now, if you could go back to your 25-year-old self, what's the one golden nugget make sure to tell yourself to do?
Do the same thing.
I like it.
Stay the course. You're on the right track.
Awesome. Question number 2, what's the number one book you've recommended or gifted the most in the past year?
Ooh, good question. Really liked, it's a nonfiction, but it's really good. It's called The Spy and the Traitor.
Spy and the Traitor. That sounds fascinating.
Really good. It's kind of like it's like a real world James Bond, kind of Cold War era. Really hard to put down once you start it.
Okay, excellent. Check it out. Question number 3. What are you most curious about right now?
Oh gosh, yeah, that's a good one. Kind of our next offering and what that might look like. We're currently chewing on that now.
Okay. Very cool. Second to last question. Number one leadership quote or theme that you strive to live by?
Whew. I'd say Zig Ziglar. You can get what you want out of life if you help enough people do the same for themselves.
Excellent. Love it. Let's see here. Number one way you're using Chat GPT?
Not at all. I'm a dinosaur. I'm apparently a dinosaur, but I haven't used it yet.
Okay. All good. By the way, I found the easiest way to use it is just you talk to it, like versus like trying to get it. You just click the button and you just go like, "Hey,
Yeah.
this is what I'm thinking about. Like, what do you think?" You know, just kind of give you some, just this little thought
Yeah.
for listeners out there.
Oh, that's great.
Yep. Last question now. So after helping all the people you help, Ryan, build a wealth and get some freedom with their family and their wealth, how do you best stay centered in your values and stay encouraged to charge forward to reach even higher heights?
Yeah, no, I would say, for us, there's a faith behind what we do and how we do it, and that kind of propels us forward, and then is instructive, beyond that. So it's kind of a plumb line through everything we do. So it's the reason behind kind of what we do is the creative vehicle for income, wealth, and all of that, and then it's the same plumb line for then what we're to do with it once we have it. So it's anyway.
Awesome. I love it, Ryan. And for our listeners who want to get in touch with you, first of all, thank you for being on the podcast. Thank you for
You bet.
your wisdom with us. Thank you for focusing on a niche for so long to help so many people, create and preserve more wealth when it wasn't the sexiest thing to go into mobile home parks, right? When it wasn't the
Sure.
sexiest thing to continue to hold and be disciplined and structured, right? With your approach, you've done it really well. And it shows. And I remember talking with you at the Best Ever Conference, and I want to let you know that didn't go unnoticed. And so I appreciate your diligence, your discipline, and helping so many people. For the listeners who want to get in touch with you and maybe invest with you, what is the best place for them to find you?
Yeah, so elevationcapitalgroup.com. My direct line is 407-602-7662. And email me at ryan@elevationcg.com. Looking forward to connecting.
Awesome. Thanks, Ryan. Also want to thank our listeners for listening to the episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options, sometimes clarifying their estate tax options, right? And not having a clear plan is the enemy, and using the deferred sales trust is an amazing way for you to solve those problems. You need to set it up prior to the close of escrow. You need to do some planning. If you're at all interested, go to capitalgainstaxsolutions.com. We do no-cost consultations. You do need to have $1 million net proceeds, $1 million gain. So it needs to be large enough, but go to capitalgainstaxsolutions.com. And the last thing is we just released the best ever, we call it the best 1031 exit plan. And it's a way for you to do a 1031. And in case it fails, have a backup. We have a saying that friends don't let friends do a 1031 without a backup plan. I want to make sure that you have an alternative backup plan in case it fails. Do not go with the 1031 company who doesn't allow or doesn't know how to use a deferred sales trust. Make sure you use one that has both options for you, and we can help you exactly with that. Go to experttaxsecrets.com for that. That being said, we appreciate everyone watching or listening out there. Please share this